Yo, what's going on, everyone? Welcome back to another video. In today's video, I'm going over Xauusd and the signal I sent out, and this signal that ended up doing a 7-to-1 RR, or I think we closed around 6-to-1, so about a 6-to-1 RR, and all the backstory to why we took this. We're also gonna go over liquidity in Forex and how I use liquidity to my advantage to catch this trade, and how you can use this concept to trade Xauusd very effectively. So starting off on the 8-hour time frame, when we come to the charts, right, let's say you just watched one of my videos, you just learned about order blocks and market structure, and you come to the charts. The first mistake that we tend to make is we zoom out and look at all the stuff happening over here towards our left, and we forget what's happening right now. Now, the problem with this is when we look at what's happening towards our left, right, this is stuff that's already happened. All this historical information is history, meaning that price is already passed. Now, when the market comes near those levels of order blocks, of course, we'll react. But at the moment, we have to focus on the current state of the market, the current events that are taking place. So one big mistake I see people make in market structure and order block is they'll stick to the 8, or they'll go to the daily, and we'll start looking at stuff like this from here, from a low, high, higher low, higher high, higher low, and then a higher high. And then you might be like, oh, I'll only buy when the market comes back down to this OB or this OB, which is right, or this OB. We tend to make these mistakes because we're looking too long term. And this mistake is done, like I said, because we're looking too long term and we're forgetting about the short term, not realizing that the short term has to be in alignment with the long term. So for example, if I'm looking to buy long term, the market needs to be able to be bearish short term, because the market, if it's just bullish long term and short term, it's going to go in a straight line. It's going to be extremely volatile, and everyone is going to buy at one point. So in conclusion, in order for you to buy long term, you have to be able to see the bearish short termness in the market in order for bullish long termness. So that's what I did over here. I went to the 8-hour time frame to see the short-term price action on what's happening right now, and I noticed that we've just came from a pullback. This pullback has been manipulating so many late and early sellers. So there's two types of participants in the market. There's the passive, the one who's generally more patient. He knows that he or she knows that the current move of the market is simply just a way for price to come down into a next level of demand, and that way price can continue. And then there's the aggressive, the one who sees a break of structure really quickly. They see that break of structure, and really quickly, automatically, they change their bias like that. So a perfect example of this would be right here. We can see that the market ends up breaking some demand over here, and that's also considered as a break of structure. Right away, what you're going to see is traders are going to be looking to sell, right? Sell at these levels of supply. Now, let's assume a trader gets in right away. He gets triggered in right here at this level of supply, and we delete this. From this point, you're going to be expecting a big move down, just that one big continuation. This is the aggressive seller. But rather what happens is the market goes back up. Now you're going to be on the 1-hour time frame. The aggressive trader is on the 1 hour, and he sees a micro break of structure right here. This micro break of structure, the aggressive trader is going to overuse the micro break of structure and put it above the macro break of structure, which was right here, not realizing that although the market is coming back up, it's only coming back up so price can reach this level of supply, so then it can continue its bearishness, right? And that's a big mistake we make, is we overcomplicate and we overuse the micro time frames and we underuse the macro time frames. And the same argument can be made for the macro. If you overuse the macro time frames, such as the daily, the 4-hour, the weekly, but you underuse the 1 hour, 2 hour, 3 hour, and possibly even the 45-minute, then you're going to come up with a lot of structure issues. So the best way to solve structure confusion is to have a good mix of 50-50. What I did is, on the weekly time frame, I saw that structure was bullish, and therefore when price was about over here on Xauusd, I was expecting the market to reach back down towards this weekly level of demand. Now, that doesn't necessarily mean I'm buying the second price comes here. All it means is the market is going to be bearish until we reach this level of weekly demand, and we will continue to be bullish until price action breaks this low. So this is a good use of the macro time frames. Now, how do I use the micro? Well, I'm not looking at the micro until price action reaches my level of demand. I think it was right here we reached our demand zone, and I went straight down to the 8-hour time frame to see what the reaction was. Oh, I made a big mistake. My fault. So let's go right here. So now this is the second thing, refinement. Refinement in FX is extremely important. Now on the weekly time frame, we saw that this was a pretty clean institutional candle. But if you go down to like the 2 daily, you could see that this big IC can be later refined to the next IC right here. And if you even go to the 12-hour time frame, you could refine that even more down to this one right over here. Or I guess if you refined it down to there, it would have been invalidated. So you could take the open of the 12-hour and take the close of the daily or the weekly. Now the next step is to see how the market is reacting from your POI. Now we can see that there's this big zone right here. If I take my fib out and I measure 50% of this zone, that means that the market has a 50% chance of basically reacting within the 50%. And then there's a 50% chance that the market may go down below the 50% up until here. So that means now we put this in perspective, that each zone has a 50-50 chance of how low and high it's gonna range within. So we have a 50% chance right here. Draw this a little bit nicer. And then there's also a 50% chance right over here. So now this puts things in perspective. Now, when the market reacts off of the open right away really quickly, this means that we can use the same concept of discounted and premium. So if it's a bullish order block right over here, we can use the concept of discounted. So the lower the market goes in an OB, it's actually better. And the reason I say better is because if price action reacts really quickly automatically like this, we start questioning it. Oh, why did the market react at the open of it really quickly? How come we didn't go a bit lower and then go down? Now, what happens is the market, when it doesn't use the open right away, what it's actually doing is it's creating market structure and liquidity, not realizing that the aggressive sellers, the ones who were selling all the way from over here, they're selling here, here, and over here, they do not realize that price is in a discounted order block now. Now that price is in a discounted order block, what they're doing is they're continuing to sell. And what that's doing is it's creating liquidity for demand to take over. So once the market makes that final pullback into our zone, or final impulsive move into our 50% discounted zone, what this means is that now the market has more structure to break compared to if it just reacted right away off of the open. If we reacted right away off of the open, we would have to break this in order to be bullish. But now that we actually did not react off of the open right away, we had a small reaction and then a continuation to the downside. The market has less, it needs to basically put in less buy orders in order to break the next market structure because it's really close. The next lower high is right here. If you compare that to where price action went from to break, that's about 312 pips. Now, if you compare the open to this move, that's about 400 pips. So we know that there is a significant amount of money that's being put in over here compared to over here. So it's more cheaper for the banks to buy lower in an order block. Now that price is in this 50% discounted level, so we can delete this, right? And price is in the 50% of the discounted level, we can do the same thing to this 50% of discounted zone. We could take the 50%, measure the other 50%, and then mark this point right here. And this is where you're going to catch the nicest refinement entry ever. So if you're ever looking to enter in on an OB without waiting for confirmation, this is what you want to do. Measure the order block, the higher time frame OB within Fibonacci, mark up 50%. And then after price reaches either the 50% of the high or the 50% of the low, only set a limit after the market reaches the low of the 50%, half of the OB. So once again, just to make this a little bit more easier, let's go right here. So let's say the market creates an order block right here. This is the higher time frame. Now, usually what you want to do is you want to wait for confirmation, correct? But in a case where you don't have time to wait for confirmation, or you're just, let's be straight up, you're just not disciplined enough to wait for confirmation and you're really impatient, this is what you could do. So we have an order block which the market is approaching. Measure the 50% of this OB and then draw out 50% of the bottom and 50% of the top. We'll make the top red and the bottom, we'll keep that as blue. Now the top, you never want to set limits at the top of the 50%. If the market reacts off of the top of the 50%, chances are confirmation is going to be extremely low. It's unlikely that the market is going to provide good confirmation for a trade. Rather, the market is just going to go in its one way. But if the market goes down into the 50% of the OB, at that point, what you want to do is you want to take your fib out once again, so you can delete the top, and you want to mark up 50% of the second OB now. And if you really want to set a limit without waiting for confirmation, which I do not recommend, you can now set the limit at the low of the second 50% zone. Now you've not only refined your risk, but you've maximized your reward, and that's without waiting for confirmation. Now remember, this is only if you do not want to wait for confirmation. So in a situation where you're fine with waiting for confirmation, what you could do is when the market is in the red zone, you could look for confirmation. Although I said it's unlikely that good confirmation is going to be present, that doesn't mean that there won't be confirmation. So in this case over here on XAUUSD, we saw that the market it reacted off of the weekly zone pretty nicely. Now I wasn't looking at the charts over here, but what do we see? We see this supply zone right over here, this order block, was invalidated by the demand. And this can only lead to one conclusion, and that conclusion is that this OB, after we reach the 50%, the market had reached such a discounted cheap price that we are now the market makers were able to push price up, and they're ready to buy. This also proved that our discounted OB was valid. Now from here, obviously the market continues to go up. We continue to break more structure, but what's also happening? All the retailers who were looking to sell from all the way up here, from this high, this high, this high, this high, all that liquidity is being grabbed now. So every single aggressive seller who is holding positions from all these swing point highs, their positions are now at risk. But what they haven't realized is that the buys have been in the market now. So some may be thinking, oh, I'll just look to sell at this point, right? Or maybe I'll sell at this point because price hasn't approached those levels yet. All they're thinking is that this is just a retracement for a higher time frame continuation. But what they do not know is that price has approached a higher time frame demand zone, and we're actually in a macro bullish structure. We're in a macro market, which in the bias is bullish. So it was right over here in which I saw this 8-hour downtrend, and these setups are very, very, very powerful. The setup that I'm talking about is this one right here, which I'll draw out. When the market is in a higher time frame movement, but then we drop down to the smaller time frame, and what we see is this downtrend. Now obviously there's two things you could do. Obviously you're going to say, okay, find the OB at the low of the impulsive move, which is right here, and then look for the break of structure. That's exactly what it is. But to put it in more perspective, what I like to do is I like to draw out the downtrend. Right, the downtrend like you saw right over here. I drew out the downtrend of the lower lows and lower highs. Now the second, and it has to be a macro. So if the downtrend is on the macro time frame, then wait for a macro break of structure. So in this case, I mapped out my lower lows and lower highs. All I was waiting for was a macro break of structure. And I'm not looking at this supply zone. I'm not looking at this supply zone because we've entered a macro demand zone. So all this micro stuff is no longer useful to me. Is no longer of use, and you can now invalidate it. But to the retail eye and to the one who are the smart money eye who's looking to sell, they see this big reaction. What do they also see? They also see a break of structure. You can see that the market created this low, this high, this higher low, this higher high, and then there's an impulsive move down that breaks structure right here. So what the smart money, I'd say 50% of smart money sellers are doing is they're looking to sell at this big zone right here, not realizing that this is all liquidity for us. And this is called future liquidity because this limit has not been activated yet. So if we set a limit right here, right, to me and you, we do not know how much limits are set there. But the banks and the market makers and the hedge funds, they know the exact number of how many limits are set right here. And from there, they calculate all the lots. And then from there, they realize that there's a bunch of stop losses resting right over here. So what's the fix? What's the simple fix to this? Like I said before, the simple fix is to not overuse the smaller time frames and not overuse the higher time frames. Have a good mixture of both. In this case, I use the weekly time frame to understand that there's a weekly demand zone that price is approaching. And then from there, I went down to the 8-hour time frame and the 4-hour to realize that microstructure is bullish. So if we have a macro POI in which resulted in a micro break of structure, then we will follow the macro. The macro is always king. So this is like the, all right, that's like it's a hat, a king's hat right there, the Amir. So the macro is the king now, and therefore you want to follow the macro instead of the micro. Now, how did I catch this trade? Well, let's go back a bit right here, and let's clean up the charts because this is getting messy. Okay. So what I did is I went down to the 1 hour from here. And on the 1 hour time frame, number one, we saw our macro POI and what it resulted in. And then we saw that the micro is also bullish after we broke past this micro lower low, lower high trend. Now, from here, we created a new point of interest. Now, I could have set limits at this point of interest, which means it was valid to set limits because we've already reacted once. We already reacted off of a higher time frame POI. So technically setting a limit right here would be valid. But the problem with this is it was a very big zone of 100 pips, and a 100 pip zone is not a good amount of pips to risk. Although it's not about pips, it's more about percentage. So even if I'm risking 100 pips, at the end of the day, it's only a 1% risk that I'm risking. So I would be losing the same amount whether it was a 2 pip zone. I'd be risking the same amount, which would be 1% of my account. But the thing is, my lot size would be super low. I would have to accommodate my lot size for the pip amount, and therefore my reward would not equal to a high reward, and it would end up and the trade would end up to be like a 3-to-1, a 4-to-1, 5-to-1, and the amount of time you're also going to be holding this for consolidation in. Now let's move on to the next thing. So price action enters my zone. Now after it enters my zone, I went straight down to the 1 hour time frame. Sorry, it was not the 1 hour. I went straight down to the 5 minute time frame. It was the 5 minute. Now on the 5 minute time frame, this is what I realized. On the 1 minute, we saw that price action created this lower low, lower high. Now let's use the same concept that I used before about the Fibonacci. Let's measure the fib, or let's measure the zone, and let's mark up 50%. Now, if you're looking to sell, or if you're looking to set a limit, then you would want to wait until price comes into here and then do the same thing. Measure the 50% and then set a limit at that 50% point. But if the market does not come there, this point to this point, so this big 50% zone right here, where price is higher, this is the confirmation zone. This is where this is confirmational, and this is where things get aggressive. Either the market is going to sell off and break your zone, or it's going to move away really quickly. It's one of those two. So in this case, what I did is I saw that price was in the top 50%, which means I have to wait for confirmation. And then I was on the 1 minute time frame and watching how the market was moving. So we saw that there was this lower low, lower high trend following right over here. And then there's this impulsive move that breaks structure. Now this impulsive move, it broke structure, but this is just a mini break of structure to create a final manipulation to enhance and take every single buyer. By enhance, I mean we're inducing buyers to buy because of this break of structure. And this BOS is really, it's high. It's really hard to avoid this. It's really hard to avoid taking a loss here, because luckily I wasn't on the chart. But if I was on the chart, I would 100% set a limit right over here, right? Because there's no way to confirm that this is going to be a manipulation until after the fact. So when you get triggered in and the market goes your way for a bit and then price comes back to stop you at break even or take you out, what you're going to be, majority with the psychological brain is going to come to the realization to is it's going to think that, okay, price broke my zone, I'll just call it a day. I don't want to risk it anymore. But then the market goes up and it gives you more opportunities. So there's going to be multiple manipulations within a confirmational bias. So there's going to be multiple situations and fake manipulations before you catch that one big buy move. And this is why in smart money, we say we lose more than we win, but our wins are much higher in RR. So at this point, what I saw was there was a strong break of structure right here. And then we just continued price. Price just kept on continuing. At this point, I saw that this OB was mitigated. This OB was mitigated. So what can I do? What I saw was we had this 1 minute point of interest right here, which hadn't been mitigated yet. Now, I did two things. I was thinking that, okay, there's also another point of interest all the way down over here, right? Now, not only was this a point of interest which was mitigated, so that means that technically you could have just taken this POI from the beginning. But if you wanted to be safe, what I nowadays do is I find the swing point low, the protected low. So the protected low, what it is basically this is where the buying started. And that means that anything that happened from this low to this high was all smart money buying price back up. And price needs to maintain this low in order for the market to continue bullish. So that means that if this point of interest was correct, this 8-hour POI, and the market is no longer looking to go down, then we need to respect this low. Price cannot break below this low. How do you know though when a swing point low is created? The best way to know when a swing point low is created is to see if there's any break of structures, is if the point of interest resulted in any breaks of structures. In this case, we saw that there was a break of structure here. And if we zoom out to the higher time frame, such as the 1 hour, you could see that we've actually also broken more structure right here of this area of supply, which the market disrespected. So therefore, once we see all this break of structure, we start to question that most likely if the market did use this point of interest the way we were expecting, then there's no reason for us to go lower because we've already broken structure. We've already broken past all the traffic. So think of the market like a highway, right? There's a highway with a bunch of traffic. Now there's cars everywhere. So these red cars right here, these red dots represents cars. So it's traffic everywhere. You're the blue dot right over here. So smart money, what they see is they're struggling to get through the traffic. They finally get to the top of the traffic, and then it's straight price action from there. So what they're not going to do is they're not going to come all the way back down to where they started, or they're not going to go back into traffic. Instead, what they'll do is they might reverse, come back down to pick up some more cars, pick up all their friends, and then it'll reverse. It'll continue with all their friends right here. But price will not break where they started off. It will never go back to where it started off. That's like losing right there for them. So they won't go right to where they won't go back to where price started off moving on from. So in this case, we saw that the buying commenced right here and price is now over here. The market shall not break this low. It doesn't make sense. So to be extra safe, what I did is I took the 1 minute point of interest and then I set my stop loss at the low of this OB, which was still not a big difference. It was only like 20 pips, and that's still pretty low considering it's gold and how volatile gold moves. So this was my point of interest. Now at this point, I set my limit right here, and let's play this out. Let's go to the 1 hour now. Let's play this out. So I set my limit right here. Price action enters and it reacts right away. We get a nice reaction right away. Let's play this out. So price action comes in. It comes in and it only reacts off of this point. So price does not concede lower than here. It actually holds the zone very, very well, and it also provides more confirmation. Now notice that after every point of interest we go into, right after price action first reacts off of the 8 hour and then the 1 minute, and then we scale down from the 1 minute to like the 10 second and we react to this point of interest, right? What's happening is every single pullback there's a seller. In order for a buyer, there has to be a seller, and in order for a seller, there has to be a buyer. So it's a zero-sum derivative market. Someone needs to lose to win, and someone needs to win to lose. So in this case, what's happening is liquidity is being created, right? The market is basically moving in terms of ranges. So the range is, let's see if the market provides confirmation. So it did. Right over here, there is a very clean confirmation the market provides. So that means that when the market was going down to tap this point of interest, there was someone looking to sell from this point to this point. And that person selling, created liquidity so demand can continue higher. So all this liquidity that we talk about, it's what's powering the market to continue and go higher. Now, our entry was already sniped right here, and my stop loss was at the low right over here for a 21 pip. And my take profit was a 6-1. I was targeting this high right here. So sorry, it was a 7-1, not a 6-1. We closed at a 5.8-1, which was like a 6-1 basically if you refine it. What's the word? Round it up. So it was a 6-1. So our entry gets filled right away. Once our entry gets filled, what we notice is the next range that the market is going to be approaching is this range, because this point to this point is where people were looking to sell. So there's retailers looking to find the break and retest. For example, right here there's a level of resistance, broken into support, broken back into resistance, and you see these wicks. Now this is creating liquidity at the top, so therefore the market now is more prone to go higher because there's money and it's like a magnet. Once that is taken out, what happens? Once a new high is taken out, what happens? The market creates a new high, and then once again, it lets sellers sell. It's letting sellers sell so that they can use that future liquidity to go higher. And then this is where my re-entry was. So we saw that sellers were selling, and we created this new point of interest. Now, there's also another point of interest right over here, which the market reacted off of. So same concept. We go back to the 1 minute. We can see that price action creates this OB. The market lets sellers sell. They start selling. They start selling. They start selling. Once we reach this point of POI, the selling is no longer valid. And it becomes invalidated because demand takes over supply. And then from this point, every little bit of selling pressure that happened is no longer valid. And what happens is institutional traders and retail traders are looking to sell. They're looking to sell this area of supply. They're looking to sell this break and retest once again. There's a test of resistance, another test of resistance, another test of resistance. They create all that money, and then look at how the market moves in such a volatile way in that direction. So it's not like it's a game or something. It all makes sense. It's not planned, or it is planned. It's not predicted, it's planned. So the markets have planned to do this because they know where the money is. So the next time you approach the charts, right, approach it with a logic, a specific logic with where is the most money right now and where is the least money. What you want to do is you want to follow where the least retail money is being injected and target where the most retail money is being tested. So then my next point of interest was right here. I saw this new point of interest. I saw that I could have refined this. I think, yeah, it was on the 15 minute. I could have refined it, but I chose not to. And I set my limit right there because price had already reacted off of this higher time frame point of interest. And then we get triggered in. Now the same thing is going to happen. So gold follows this specifically. Once price action reaches this point of interest, we create a range from this point to this point. So if this point of interest is objectively correct, then do not worry. We have to breach this point. Price needs to breach above this high. That's basically like the bare minimum. So that's a good thing. Now that's how we increase our RR. So now imagine if I entered at this non-discounted point of interest, right? My RR I'd be targeting here, which would be a 4-to-1, and that's not the best RR, correct? But if I enter over here, there's much more probability in this OB because number one is discounted, and now I can target higher. I can target a lot higher because this is the bare minimum, correct? Now that this is the bare minimum, that means price needs to breach this high because there's swing point. There's buy stops resting above it. So there's certain retailers, what they try to do is they'll buy right away once price breaks above the zone. This is called the breakout strategy. Now this breakout strategy, it works is the second the candle closes and breaks above, there's buy stops and they get triggered right away. Now this is called sell stop, buy stop liquidity, or swing point low, swing point high liquidity. So we know that the market has to approach this high to do the bare minimum. That's about it. Now, if our point of interest is correct, then there should be no problem at all. You just need to hold this out. And as you can see, that's what happens. The market breaches this point, the buy stop liquidity gets triggered, and then the market reverses. So it's very, 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 very frequent how the market reverses the second the buy stop liquidity gets taken out. The second the buy stop the second the buy stops are triggered. So now that the buy stops are triggered, the market realizes that we're this close to our point of interest. And the breakout strategy consists of just catching maybe 10 to 15 pips. So if we give them that 10 to 15 pips, they'll be winning. Well, so what the market maker does is it reverses price. It takes price back down, takes them out, finds another point of interest, and then it goes to the next POI, which was my take profit. So in this case, if the market wanted to stop it out and then hit our take profit, the market would go all the way back down to mitigate this point of interest. But it doesn't necessarily have to do that. Sometimes it may, sometimes it won't. It's all up to the market. So in this case, we see price comes back down to this area of demand, and then it consolidates for a bit. But once again, where is the bare minimum? The bare minimum where the market has to come to is right over here and right over here. These two swing point lows. So if I was looking to buy, which I wasn't at this point, I had already closed the trade at around here. So we closed the trade at a 5-to-1 for this one, and this one was we closed it a little bit early. We closed this at right here. We closed this right over here at a 5.95. So if I was looking to buy right over here, I can objectively set my take profit right here and not worry at all, because now I know that this is going to be the next micro protected low and that the market cannot break this low for the time being. So play this out, maybe coming back down just to grab a bit more demand, get a couple more orders in. Let's go to the 5 minute to hurry this up, and then you get your take profit hit. And this is 1, 2, 3 trades, which I only caught 2 of, but 3 trades you could have profited on just by following the demand. So to make this even easier, let's delete everything and let's just take a look at what happened. the market breaks structure, right? We break structure right here. And then the market retests this order block. From here, we have an impulsive move up. Then we come back down to this order block. From here, we have another impulsive move up. Price action comes back down to this order block. From here, you have another impulsive move up. The market comes back down to this order block. From here, you have another impulse. So basically, price is just creating order blocks after every impulsive move, in which price action always comes back down to mitigate. We had 1, 2, 3. So there's 3 entries right here that you could have profited on, which all had confirmation. Besides, I'd say, this one had confirmation too if you go down to the 1 minute, because price action reacted off of this point of interest right here, and which that POI reacted off of this POI. So this is the setup that I always see on gold, is when price is inside of a point of interest. And we can hurry this up and see where gold's at right now and which price is over here. So when price action is in a point of interest, a weekly, daily, whatever, it's in a higher time frame level of demand, this setup is always there, where the market creates a impulsive move and then it comes back down. Or it not comes back down, sorry. It creates an impulsive move and then it creates an order block either at the 50% or below the 50% or at the below of the OB. And then price action comes all the way back down to mitigate, and then it goes back up and does the same thing. So this is the fractal setup. The market is literally doing the same thing. We have an impulsive move. We create a new OB right here, another new OB right here. The market mitigates it and then does the same thing, another impulsive move. Now this is called following the demand. So if you could consistently follow the demand, and remember, this is done on every time frame. It's the same same concept on every time frame. For example, on the 1 hour now, we can see that there's a 1 hour BOS. So what am I going to do? What I'm going to do is I'm going to find the impulsive move that caused that break of structure. In this case, we have 1 and then we have 2. Now all I have to do is look for the OB. We have an order block right here. Now obviously there's a wick over here, and usually when there's a long wick below an OB, that usually means that there was liquidity that was grabbed. So if we go down to the 1 minute time frame, we could see that there was this dynamic support that was being followed, as in every time a retailer touched this trend line, or every time price action touched this trend line, a retailer is thinking that this is getting stronger. This trend line is getting stronger, when in reality it's getting weaker, because the more retailers that buy, the weaker a level is getting. So basically, now that this trend line had been touched multiple times, this level got weak and eventually it was broken. So this move down was actually a liquidity grab. So now you could refine this point of interest which you had. Let's go to the 5 minute and take it as this 5 minute POI. Now, not only that, but look, price had reacted after we entered a higher time frame POI right over here. So therefore, this would be valid for limits. This setup right over here that we're looking at, which is about 38 pips in stop loss, it would be valid for limits. And where would you target? Well, you would target the bare minimum. The bare minimum, where's the bare minimum? The bare minimum is right over here. Now, that's a 2-to-1. Right, so now you have 2 options. Either you could wait for more confirmation to minimize the risk and maximize the reward, or you could just target where you see gold going long term, which would be a 6-to-1. Now, this is totally fine. It works. This is normal. This is fine. You could do this. It matches the plan as long as there's confirmation. What you could also do is possibly refine this POI even more down to here. But I noticed that what the problem with refining too much is price action may come near your point of interest and miss it by like 1 pip, like comes near it and then reverses right away. And you might get confused. Oh, was this inducement? Was this the market missing my pip? Is it going to come back down? And then you start chasing trades, revenge trading. And then either the market comes back down to your POI and then it enters you and then you delete the limit by then. So it's really annoying. So the best way to do this is just to take the normal refined one, not the over refined version. Take the normal refined one, wait for confirmation, or set a limit. But do not confuse yourself. Set one of those 2. So that's how I got these 2 trades on XAUUSD. The total of that was about 11 to 10 RR. I honestly only caught about, I think it was 7 to 8 RR on that because I closed early. But this trade, not only did this trade make us a good amount of money, but it also helped me pass my phase 1 of my FTMO challenge. And I'll also be providing proof of that. So if you want proof that this did pass me my phase 1 FTMO, read the description and I'll provide a screenshot. So I hope this video was helpful. Thank you guys so much for watching. If you have any comments, questions, or concerns, let me know. Leave it in the comment section below and I'll get back to you. And if you want to support your boy so he can keep posting more fire content as usual, then make sure you leave a sub, like, comment. It helps the algorithm boost my channel more. So once again, thank you all so much for watching. I'll catch you all in the next video. Peace out.